Good afternoon to all of you.
Good afternoon.
Good afternoon.
Good afternoon.
So welcome to our class, okay? And in the morning, the morning class, another comment I made is that don't forget at the end of the day, okay, when it comes to the calculation of the cycle, the examiner will not give you the days, okay? Quite unlikely that will happen. The conventional case will be that the examiner will be asking you to get the cycle and you're meant to do the calculations, okay, to get a number of days, okay? And you see that these formulas you may have to get to know them, okay, all the from the days for material all the way for the days for payable, okay. So I want us to do a question that is asking us to get the cycle, okay, based on the number of days, okay, get the cycle, and we are the one getting the days, okay, for each of the key component, okay. So let's do a question from the. I think I have a question on my notes here. So let me see whether I can get it. It is. Okay. So go through the question, then we attempt to do it together. Okay, go through this question, we attempt to do it together. Okay, I presuppose that you've gone through the question, you understood what the examiner, what the question requires of you. So in this example, we are meant to get the cycle, and for this company, as you may have observed, you can see that the inventory is subdivided here: raw material, work in progress, finished good, which means that this company is in it is involved in manufacturing. Okay, so therefore, what do we need to do? Let me get an image of this question. Okay, so let's work it out together. So guys, my skin is frozen. Give me a minute. Seems to be back. Yes, okay. Okay, so we need to get the days for raw material. So we can begin by getting raw material days. We don't use the list 5, therefore it will be the list 5. We multiply by the raw material investment, that is the amount of raw material the company has at that point in time. And if the raw material investment is 108,000 pounds, okay, so 108,000 pounds, okay, we divide by the total raw material purchases for that year, which is 518,400. How many days for raw material? You can convert the days to the nearest, because I think you'll get decimals.
76 days.
And 6 days, okay. We get the days for work in progress day, or the production days, that is 65. We multiply by the work in progress investment, okay, which is equal to 25,600. We divide by the cost of production, okay, which in this case is 525,000. 525,000. How many days therefore?
So I think it's 675.
625, not 5, sorry. 625.
Yeah.
Thank you. 625.
Yeah, you get 41 days.
41 days, okay. Then we get the days for finished goods. Okay, and as I mentioned, if the company is not involved in production, then its total inventory days is again equal to the finished goods. Equal to the district 5, we multiply by finished goods. Okay, and the finished good investment for this case is equal to 86,400. We divide by the cost of sales. Okay, and the cost of sales will be the cost of goods sold. Okay, in this case is equal to 864, I guess. Oh, cost of production, yeah, 864. 756. It's 756,000. Okay, to give us how many? To give us how many days? Therefore,
42 days.
42 days. Okay, we again to get the list for the receivable, what we call the debtor's day, receivables days. The risk 5 we multiply by the number of the investment the company has made towards its customer at a point in time, which is 172,800. We divide by the sales made on credit. We assume therefore all sales made in the company were on credit. Okay, because as you can see, we have not been told how much of sales were on credit, but now we assume that all sales made were on credit, which is equal to 864,000. Give us
73 days.
93 days. 93.
73.
Also in 3 days. Okay. Then we less the days for payable. Payables days. 365. We multiply by payable the amount of payables, that is the amount we owe supplier at a point in time, 86,400. We divide by the goods that are bought on credit. Okay, it's hard for now to know how many goods were bought on credit. So therefore, what do you do? You're going to do therefore the cost of sales, and the cost of sales in this case is 756,000. Is it? Yes, 3,000 with the goods bought on credit, or rather the cost of goods sold. We get how much?
42.
42 days. Okay, we less 40 days. Okay, and that's give there for the cash conversion cycle. And how many days do we get? 41.
190.
190. So you get 190 days with the cash conversion cycle. Is the company doing well or bad off? You can't tell because you don't have a point of comparison. You do require data to compare with. For example, last year, cycle or maybe the industry cycle, but now you can make a comparison. Okay, based on the cycle you have there. Okay, but get 190 days. Okay. Great. Now let's look at the examiner, because the examiner, of course, is going to ask question from this area. This question bank. Okay, here it is.
So can we first see the question we've done? Just please.
Right now.
Yeah, I just want to take a shot of the question we've done.
Okay. This one?
Yes. Thank you.
Okay, great. Yeah, where is the question bank? Yeah, it is. Okay. So I want us to do a question asking us to do calculation on the cash conversion cycle. Let me begin from the first page. That one. Maybe just a quick one. In page, this page is this page 5. The question begins from page 4, continues to page 5. PKA company called PKA company. And you've been asked, okay, in part A of that question, identify the objectives of working capital management and discuss the conflict that may arise between them. Okay, for 3 marks. Okay, I think you have discussed that. Okay, so there are 2 working capital objectives: liquidity and profitability. Okay, liquidity is more towards to ensure the company we now have maybe liquid assets in form of cash to be able to pay, that can suffice, okay, to pay for the maturing obligations. Profitability is that the company want to make positive returns from their working capital investment. But you say that, don't forget, the two objectives will be in conflict, okay? If as a company you do pursue more towards the profit side, then that imply more you'll be investing more towards the non-current assets, okay, which are deemed to be liquid assets, okay. That means therefore the company liquidity might be hurt, okay. On the other hand, okay, when it comes to if the company pursue more of liquidity, okay, that implies that for company investing in more liquid assets, cash, money market instruments, okay. Don't forget these yield very minimal returns. Okay, that means therefore the company is going to be liquid. However, the profitability is going to be very low. Okay, for the remarks, don't forget. No, the marks altogether to what extent you need to discuss a concept. Okay. See. Should be a question here. Yes, we can get it. Let me actually just do a search. Cash conversion cycle. Yeah, it is. Okay. CSZ company. This is page 49. Page 49. A company called CSZ company. Page 49. The question begins from 48 to 49. A company called CSZ company. Part A of the question is asking us, where is that CSZ company? Oh, okay. You it again. Okay. So part A of the question is asking us, calculate the working capital cycle, the cash conversion cycle of the company, and discuss whether the working capital cycle should be a positive or a negative. By the way, should the cycle be a positive or a negative?
Is that a question, sir?
The question.
Okay. I think if it's negative, then it means the company does not have payables.
The company does not have payables. Think through your answer.
I think if it's negative,
it
implies that the company.
Yeah, that means the company. Continue.
It implies that the company has way more debt than it has assets, sort of. So it is over. It's not over trading. It's over. It shouldn't be negative.
It should not be a negative.
Should not be negative.
Let me give an example. In the case of retailers, supermarket, for example, do they manufacture? Let's say example of a supermarket. Are they involved in manufacturing? And guys, in the case of retailers, okay, an example could be supermarkets. Are they involved in manufacturing? No, they don't manufacture it.
Yep.
Which means that they have 0 days for work in progress, 0 days for 0 days for what do you call it? The 0 days for raw material. Okay, they don't have. Then when it comes to the finished goods, okay, when it comes to the finished goodies, okay, of course they'll be having some there because they are going to buy the commodity. And actually, do they even buy them? Anyway, that's what they do. They buy the commodities from suppliers, okay, and in quote, wait for the customer to come and buy those commodities up. So therefore, there'll be inventory days for sure, okay, in terms of the finished goods, okay. Then do they sell on credit or on cash?
Cash.
Of course, cash, which means that for the days for debtors will be 0. Okay. Then the other thing, when they buy the commodities from the suppliers, okay, do they buy them on cash or credit? Okay, falsely. Buy a cash or credit?
Credit.
They buy them on credit, and actually most of them they pay. I remember in the case of Nakmat, during the time of investigation, they were paying the supplier after 6 months because the deficit is too long. Anyway, for most retailers, okay, they'll be having what we call a negative working capital cycle. For most retailers, will be having, an example is for market, having a negative working capital cycle. Does it mean they're doing poorly, or what does it mean? Okay, does it mean that they are mismanaging working capital? Not necessarily. It's because of the nature of their business operation, they will be having necessarily a negative. The case of Safaricom, okay, what do you expect, by the way? The case of Safaricom, what do you expect? Positive or negative? What do you expect of the cash conversion cycle of Safaricom? Okay, service within the company. Positive or negative? Think of the days for inventory, the days for debtors, and the days for payables.
It's positive.
Why do you think it's positive?
Because they have more receivables than payables.
Are you sure?
Okay, for instance, every service you get at Safaricom, apart from the loans and Fuliza and all that, they are instantly paid for.
So you pay them in
Or
advance.
rather, you prepay and then you use the service. You first pay.
Which means that for Safaricom, is that a payable or a receivable?
For Safaricom, that's okay. For them, it's a receivable. Okay, I'm thinking like a customer, yeah?
Yeah.
Okay, yeah, for them is a payable.
It's a payable.
Yeah, for them. But for me, yeah.
For Safaricom, is it going to be more of payable or more receivable?
It's sort of balanced because they have. Okay, yeah, that's what I think rather.
Okay. So do you think it's be more? You think it's a balance or more? Which side do you think it falls?
Okay, probably payables.
Don't forget that's what going to happen actually. In most, okay, I don't know whether our accounts for Safaricom, that would have made our things easier to explain. Let me see if we can get the accounts for Safaricom for 2020 so that we explain from a point of knowledge. Okay, statement for Safaricom. Okay, let me see if I can get accounts for Safaricom for the 2020. Okay, we explain from point of knowledge. Annual report 2020. Go straight to the accounts. Should be below here. Here we go. I hope they'll be visible. Most of the time PDF are not the best. SFP 2020 SFP. It's visible. You can see it.
You have to zoom a little though. It's visible.
How is it now? Better?
Yeah.
Okay. Now let's go through the current assets. Let me go to the current asset. Give me a second. Okay. So you can see therefore the company current assets for the year 2020, okay, was equal to 48.8 of billion to 48.8 billion. Okay, that's the company total current assets. Okay, and of course, in case you want to check on the receivable for the company is 17.1 billion. Okay, you can see all that. Okay, this is the receivable value, 17.19, or simply the total current asset is 48.8 billion. Okay, now let's look at the current liability for the same year. Okay, so let me go next. So this is the company current liability for year 2020. You can see it's equal to 56.5 billion. Okay, they have given a negative working capital position of equal to 7.7 billion. Now, could you conclude that the company, you look at the payable, okay, I think if you remember the payable, it is equal to 30 billion more or less, okay? The receivable was 17 billion, okay? That is very much expected because if we take the case of Safaricom, okay, they recognize once, for example, you do load a credit, okay, what happens that they are yet to receive, you are yet to receive a service from Safaricom, which means therefore, to them, that's a payable because they're here to give you the service. Okay, they're here to give you a service. Therefore, they're not going to recognize that as an income so far. Once they provide the service, that's when they're going to therefore recognize the income on the side. Okay, so to the Safaricom, once in case you have a credit worth 1,000, that's it's a liability to them because they must provide you with a service equivalent to 1,000. Okay.
Oh, yeah.
That's therefore the payable balance is going to be high. But of course, in case things will change in time, that most customers become what we call postpay, okay, then of course the reverse will occur now. Okay, if most customers becomes postpay, they'll be owing Safaricom. Okay, therefore there is the case of the receivable will be increasing. But as per now, because there's more of prepay than postpay, that's we have therefore this scenario, and that's what you expect. Therefore, the accounts of the company ought to be reflecting. Okay. So in this case, for the year 2020, okay, the company will be having a negative working capital position. Does it mean it's doing poorly? No. Okay, it's simply the nature of the business they are involved in. Okay, then we do expect, okay, that they'll be having a negative net working capital position. For a service-oriented company, retailers, telecommunication companies like Safaricom, for example, you do expect they'll be having a negative working capital cycle also. Okay. If a company is going to be manufacturing, then they ought to have a positive. Okay, let's do an example, like Baburi. Okay, so you don't have for year 2020. Let's see if you can get the accounts. Okay, this is more manufacturing. Therefore, what do you expect? We expect to have a positive. Okay, half year. There's no full year. You have full year. Okay, you don't have the accounts for 2020, but then let's take for 2019 here. So this is from Baburi for 2019 current assets. Let me see if I can go to Zoom. You can see them. They're clear.
Yes.
Okay. So you can see that for year 2019, the current asset of the company is equal to 8.9 billion. The current liability is equal to 7 billion. Okay, ending up having a positive working capital of 2 billion. Okay, but no, this is very much expected because this company is in a manufacturing industry. Okay, that's why we are expected to have a positive working capital. If it's a negative, then there's a problem somewhere. Okay, this might indicate that there could be working capital mismanagement. So to answer the question, okay, let's go back to our question. Okay, the question was asking us discuss whether the working capital cycle should be a positive or a negative. No, there's no clear-cut answer. Should it be a positive or a negative? Don't forget, one of the key factors determines whether it's going to be a positive or a negative is the nature of the business the company is involved in. Okay, so it's not always going to be a positive or a negative. Okay, one of the key things that influences whether it be a positive or a negative is the nature of the business or the operations the company is involved in. Okay. Clear? Okay, the first part was asking us to get the cycle. Okay, go through the question and we get a cycle for this company, this CZ company. Okay, I hope you've gone through the question. So here the examiner was asking to get a cycle was at the end of March 2014. Okay, the sales we told is you got 40 million. They're all on credit. Cost of sale is 26 million. Okay. And that is it. There are the number of days we're meant to use in an year. How many days to use? We are not told how many days to use, so we can assume to use either the 60 or 35, no problem. So here you can see the company has inventory, there's a receivable and there's payable, which imply therefore we do need to get the days for inventory, the days for receivable, and the days for payables. Okay, and as I had mentioned, don't forget, we don't need to get the days for raw material, the days for the work in progress. Why? Because for this company, it seems not to have them. So we only be getting in quote sort of like the finished good days. Okay. So let me get my writing pad. I'm not sure where it is. Give me a minute. Okay. So in this example, we do need to get the days for inventory, or rather like the finished good days. So inventory days, we use 365. Okay, let's do this 360. We multiply by the inventory investment, in this case 5.7. Okay, 5.7 million. We divide by the cost of sale, and the cost of sale usually is equal to 26 million. Okay, that's good for the days for inventory, or rather like the finished goods. Okay, then you have the days for receivable. The 60, we multiply by the receivable investment, which in this case is equal to 56.75,000. We divide by the sales made on credit, 40 million. That gives therefore the days for receivable. The days for payables days, the 60, we multiply by the amount we owe supplier at a point in time, 2,137,000. We divide by the cost of sale, which in this case is equal to 26 million. Okay, therefore don't forget this is we less the payables days, and that gives therefore the cash conversion cycle, which is how much? Or the cycle?
108 days.
180?
108 days.
108.
108.
108. 108. Confirm?
Yeah.
Someone to confirm? Sorry?
I got the same.
Okay, great. So you get 108 days to be the cash conversion cycle for this company. I'm not sure whether they can be able to do the other part. I think we can do the other part because we do require us to run some concepts which we are yet to learn. Okay. So we get 108 days. Okay, you can see quite an easy question. Okay. Okay, let me see if I can get another question. Now the others we have done for now. Okay. Yes, I think we can do this question. This question 13, page 53. Page 53, question 13. Okay, first make the attempt. Let me see how far you can go. Question 13, page 53. So you've been asked to get the net working capital, which means therefore you have to make the working capital, not working capital, the investment in the receivable, the investment in the payables, the investment in the inventory, the subject of the formula. Anyway, let's do it together. So let me get an image of this. So let me get my working area. Is this? Yes, it is. Okay. So because the number of days for receivable is 50. Okay. Don't forget the formula I gave you for receivable. Receivable is equal to receivable days is equal to the number of days in an year. How many days to use in an year? There is 60. There is 60 times the receivable. We divide by the sales made on credit. Don't forget, now we want to get the investment itself, okay, for receivable. So what do? You make the receivable the subject of the formula, okay? Therefore, receivable investment will be equal to the rate for receivable divided by 360. We multiply by sales made on credit, okay? Because now we've been asked to get the receivable, not the dates, because the dates are given to us. The date is 50, so it's going to be 50 out of, it'll be 50 out of 360. We multiply by sales that were made on credit, which you've been told is equal to 27 million. And you get how much?
3750,000.
3 million.
750,000.
750,000. That way.
Yes.
The way it is.
Yes.
Okay. Okay, first therefore the amount that the company need to invest was the receivable. Okay. Then towards the inventory, the same process again to follow. The days for inventory. Okay, I gave the formula to be equal to the inventory or the finished goods, in case you want to call it that way. Inventory, we divide by the amount we invest towards inventory, time divide by the cost of sales, divide by cost of sales, time 360. We want to get the inventory because we have all the other values. So therefore, the inventory will be equal to the number of days, which we have been told is 60. 60 out of the 60, we multiply by the cost of sales, and the cost of sales is equal to 15 million. Then how much is the inventory investment?
2.5 million.
2.5 million.
Yeah.
2.5 million cover for the inventory investment. Next, we need to get the payables investment, payable investment. Payables days, for the formulas I gave you, is equal to 360. We multiply by payable. We divide by the cost of sales. Now you want to get the payable. So what do? You make payable the subject the formula, which payable being equal to the number of days for payables, divide by 360, we multiply by the cost of sales. The days will be for payable is equal to 45. 45 divided by 360, we multiply the cost of sales, which was equal to 15 million. Therefore, how much is the investment in payable?
$1875,000.
1875, that way.
Yes.
Okay, great. Don't forget the net working capital or the net investment. We say is current assets. The net working capital is current assets of the company. Current assets minus current liabilities. Okay, I think we said that minus current liabilities, which is caused therefore inventory. And the inventory balance we got 2.5 million plus receivable, and the receivable we got 3.75 million. Minus the payable, and payable we have gotten 1875. And you get how much, therefore?
4,375,000.
4,375,000. Okay, and that's how we get therefore the net investment or the net working capital required for the next financial year. Clear? Brian, you got something different?
I didn't think they were asking for the net working capital. They're asking for how much you'll invest. So technically in total, you're investing the sum of all this. But if it's working capital, it's 4.375.
Don't forget they're asking about the net. Okay, so the term there is quite clear. It's net investment. We need therefore it will be net of the payables also. So current assets minus current liabilities. Okay. Okay, great. So that's on that. Okay, then let's see, you can get another question. The examiner, what's happening here? Okay, unless we can get another question, we can attempt. Okay, you've done that. And by the way, most of the time, if you're not careful, all the answers the examiner gives in the exam, you can get them along the way. So you have to be quite careful. You don't want to leave the exam thinking you have passed. So you have to be very careful, because most often than not, all the answers given by the examiner, they will be there. Okay, if you make a mistake, there'll be a choice for that. Let's see, can we get another question? Maybe I think the final question, maybe. There is another question. If I remember, I was asking to get on the cash commerce cycle. Cash operating cycle. You know, not that. I think I can do this. This can be the final question because they're not so tricky. Yes. Okay. Bolt company. So here our company. There's a company called Bolt Company that is in page 30. Page 30, page 31. We can do part A. Page 30, page 31, part A. Okay, get the cycle. Page 30, 31, Bolt Company. We get the cash operating cycle for the company. Okay, should do the next 1 minute. Tell me once we get the answer.